let's say that we bought this property for $730,000. This is a real example. We did buy a property for $130,000 and $730,000, and we used $230,000 of equity in order to purchase it. So that $230,000 down payment included money for renovations as well as the down payment. So if we can execute those renovations in a short period of time, maybe 1 to 2 years, then we can theoretically, as long as the market holds strong, increase the value of the property by $300,000, which more than doubles the equity that's in the deal.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Sujata Shyam. Sujata is a real estate investor, underwriter, short-term rental operator, and fund manager. After using her student loans to flip her first house during her MBA, she spent 4 years underwriting multifamily acquisitions for institutional buyers. And in just a minute, we're going to speak with Sujata about the math behind the money, how to snowball your wealth through real estate syndication. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how attractive our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Sujata Shyam. Welcome to CRE Radio.
Hey, Darren, so good to be here and glad to see you today.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. So I really cut my teeth in real estate after my MBA when I was underwriting multifamily acquisitions for institutional buyers like big banks that were adding, in particular, I was in the affordable housing space. So we were adding LIHTC deals, low-income housing tax credit deals to their portfolio so that they could fulfill their requirements. You have certain requirements as a bank to invest in the communities that you're in. And so what that meant is I was preparing these 80-page investment summaries and really looking at every aspect of a deal to make sure we could pass muster at our investment committee. And it was a challenging job at first. It's very, very detailed work. Have to comb through everything with a fine-tooth comb. And that's really where I cut my teeth. At the same time, I didn't want to work in a financial institution for my entire career. And I learned that it just wasn't the right environment for me. I wanted to be an entrepreneur, a founder, somebody who was making things happen outside of a corporate environment. And in order to accomplish that, I had to go on a big journey. And first thing that I did that was successful, because I tried a lot of things, but the first thing that I did with that was really gave me a lot of success was I started an Airbnb portfolio. And I like to say I kind of became a short-term rental host by accident. And that's because I didn't set out to be a short-term rental host. It was kind of a side hustle that I viewed I was just doing to get until I was able to make it big in whatever else I was doing, what other entrepreneurial pursuit I had. But this Airbnb income was just so consistent and good and solid that I ended up wanting to add more of that to my income streams. And so I just added Airbnbs to my portfolio one by one. And that actually got me to income replacement from my corporate job as an underwriter. And at that point, I decided I wanted to, I will say that I did have a real estate foundation before. So prior to becoming an Airbnb host, I had already had an investment property. I had already renovated a house during business school, started with no money. As you mentioned, I was able to do that without any money myself. Literally, I was a student. I didn't have much in the way of savings. And I just used my student loans to be able to fund my first investment property. And then I eventually bought another house and I was renting that out. So I was doing what's called house hacking. I don't know if your listeners, any of you listeners are out there are familiar with that, but that's when you essentially have tenants, either you have a duplex or you might rent rooms to your friends or find a way for tenants to pay your mortgage. And so I did that as well. And so I had that foundation when I became an Airbnb host. I had already developed some financial standing. But then at that point, I just grew in that. So at that point, once I replaced my income through Airbnbs, I wanted to diversify my income streams further and take the next step in real estate. And I knew that I wanted to play at a higher level. And that's why I founded Lux Capital, which is a private equity firm. It's a boutique investment firm. We focus on the different types of commercial real estate is where we started. And we now also do investing in different kinds of small businesses that are growing quickly. So, and we have investments that are available to any investor, or not any investor, certain investors that are at different points in their journey. Not every investment is going to be the right fit for every investor. And in general, this type of investing isn't for everyone, but that's where I am today.
Awesome. I appreciate you sharing your journey and clearly your experience at more of the institutional down to the hands-on gives you a unique perspective on real estate and the opportunities there. So with Lux Capital, you're a fund of funds, is that right? Or how is it you're set up?
Yes, correct. So what we do at Lux is we do group investing. And so what that means is that people in the Lux Capital investor family, if I will present deals to them, I help educate them so they understand what they're getting into and they can get comfortable with the process and make decisions that they feel good about in terms of where they're going to put their money. If they see a deal that they like, then they raise their hand and say, I want in on this deal. And then we go in as a group. And so as a group, we usually get more favorable terms, which means that investors are getting virtually the same amount that they would be getting, possibly even more than if they were to go in individually. And we also have a little bit more sway with the operators because we're investing as a group. We have a little bit more power in numbers. And so we started out with self-storage and multifamily. And for example, a classic deal would be we're going to buy a self-storage facility, we're going to expand it, and then in general, improve operations. So increase the income, decrease the expenses, and optimize the operations of the property through operations and expand the footprint of the place as well. And that creates tremendous value. And so then when the market is right, and that's a key point, we have to wait to sell until the market's really, really in a good place for that particular property. And we have to know who our buyers are. Are we selling to other folks are we selling to, say, a pension fund that just wants an asset that's going to produce yield, or are we trying to sell to another syndicator that wants to continue to, that there's still meat on the bone left and they want to continue to optimize the property? So that's what we do with Lux. In addition to self-storage, I'm a big believer that we want to be in multiple asset classes, multiple geographies, and work with multiple operators. Not too many, because we want to have really strong relationships with all the operators, but various operators, because every operator tends to have their strategy that they're working on and honing. And if that strategy has any weaknesses, then we want to be diversified, right? We don't want to necessarily, sometimes they're focused on a particular location. So we don't want to just be invested in Houston. We want to be in other parts of the country as well. And then when it comes to industry, different asset classes are going to face different challenges at different times. So multifamily is going to face challenges at a different time than self-storage, and self-storage is going to face challenges at a different time than short-term rentals, et cetera. And so, the goal here is to be able to sleep well at night and to have to feel a relative sense of calm with your investment portfolio, and that it's aligned with your goals and help you achieve the goals that you want to achieve. And by diversifying and spreading out the risks that we have, I feel we can achieve that right balance of risk and reward, to have peace at night.
Got it. So help me understand. So is a fund of funds, you essentially raise capital, create a fund, and then go deploy the capital from Lux, which was raised by your investors, into these different investments. Is that correct?
Yes. So fund of funds means that we create an entity that's an LLC, and that LLC is where investors fund. So then we have multiple investors into one LLC, and then that LLC is one investor into a property that let's say, Darren, you want to go buy a 100-unit property in Eastern Washington, then and we decide we like that property, we like you, we like the market. We will then invest as one investor into your property LLC.
Got it. And as far as the capital raise for the fund, do you have like a predetermined or kind of an understanding of where you're going, or is it more a matter of raising the capital and then seeking the investments based on the operators you're familiar with?
So, I'm constantly helping my investors understand what types of deals we have available. And I have in mind, I'm like, okay, these folks are going to want to invest in our next affordable multifamily deal. These folks are going to want to invest in our next, higher growth type opportunity. And then as the deal, but I don't always have those deals available because we have very strict underwriting standards, and we don't just invest anywhere. So deal flow comes, we try to spread it out with a few a year, 4 to 5 a year. And so the whole time I'm helping people understand what kind of deal they might be looking for, so that when that deal arises, then they're ready to move money. So usually we're not, some operators will do it more complicated. Fund of funds will just have a fund, and that fund invests in lots of different properties. That's not how we work at the moment. We're deal by deal. So for the most part, if you invest with me, then you would put, $50,000, $100,000, more than that potentially, into one investment. And then that just stays with that investment until it liquidates. And then you get your money back and you can do something else with it.
Got it. Got it. I appreciate you taking us through that. So let's talk a little bit about the investors. And I think I like the topic today, the math behind the money, how to snowball your wealth through real estate syndication. What's the best way? Do you have some slides you want to share, or do you want to just talk through it, or what's the best way to kind of get into this and kind of understand the math?
Yeah, I mean, I think since a lot of our investors are on listening by audio, I'll start with just talking through it so that
Okay.
our audio investors can understand it, and then we'll go to some slides later on. But
Okay.
so I think one of the most important things that got me really excited about commercial real estate is to be able to make a really good return on your money, while having a strong downside protection, right? So our deals are usually targeting somewhere in the 17 to 20% range in terms of an average annual return. And so what that usually means is, let's say we invest in a 100-unit property in Houston, Texas. So that property, we're going to buy that property and renovate it. During the renovations and the period where we're optimizing operations, there's going to be some cash flow to investors, let's say 6%, 4 to 6%. Maybe it'll go up a little bit later on. And then when the market is ready, we'll sell the deal. Hopefully it's within 5 years, but it could be a little more, it could be a little less, depending on the market conditions. And At that point, then you'll get your money back plus a large sum of money. So when you add up the cash flow distributions plus what we call appreciation from sale, that would equal, our target is usually 17 to 20%. So let's just call it 20% for easy numbers. If it was a 5-year hold, then you put $100,000 in, then by the end of that 5-year period, you would have received your $100,000 back plus another $100,000 in the form of cash flow distributions and appreciation from sale. Because 100,000 divided by 5 is 20,000. That's 20,000 per year. So that's our target. As investors are generally know, deals usually perform. They don't usually perform to pro forma. They usually don't hit pro forma or they outperform pro forma. Of course, we want to be conservative in our numbers as much as possible. But the reality is that some deals are not going to hit pro forma and some deals are going to vastly exceed pro forma. So in my mind, what I want my investors to experience is to have a mix of deals where some of them, maybe 10 to 20% are total home runs, maybe 60 to 70% of them are hitting pro forma in the range of pro forma, and then maybe 10%, 15% aren't hitting pro forma. And if you think about that as like, we all understand risk. That's what this whole podcast is about. There's some risk, but if we can spread out our overall returns over our investments, then we can achieve really amazing results. So now let's dive into, how do you even make a 20% return, right? Like that's actually kind of a lot of money when it comes to it. And how do you do that with strong downside protection, right? Like we're all familiar with the stock market going up and down really fast, and you can make a lot of money overnight. But with commercial real estate, one of the benefits is downside protection. As long as you hold on to the property, you're going to at least preserve capital, but you also stand to make a fair amount of money. So how does that work? Should we dive into that?
Yeah, no, I think that's exactly where we're at.
Okay, great. So I like to start with a very simple example. This involves some important commercial real estate terms like cap rate, capitalization rate, and net operating income. So a cap rate, just for listeners who aren't as familiar with that term or who want a refresher, it is an amount that it's usually 6%, 5%. It could be as low as 2.8%. It could be as high as 10%. But what it means is that's what the market is willing to pay for the income stream that the property produces. So if a property, let's say you own a property outright, it's $1 million property, or let's say you own a property outright, it produces $100,000 in what we call net operating income, which is the income minus the expenses. So the rent and other income that you might collect from, say, fees or laundry or parking, minus the expenses. And those are operating expenses. So one caveat is that we don't include the cost of debt in this particular, to calculate cap rate, you don't include the cost of debt. But let's say that it's a 6% cap rate and you had $100,000. So $100,000 divided by 0.06 equals 1.67 million. Divided by 100,000 divided by 0.06 equals, yes, 1.67 million. So if you have a property that produces a net operating income of $100,000 and the market is currently trading at a 6% cap rate, then that property would be worth $1.67 million. So that's cap rate. And it might take you a little bit of time to wrap your mind around it because different properties are going to trade at different cap rates. For example, a property that is stabilized and in a very hot market is going to have a lower cap rate because there's less risk. And a property that's in, say, a neighborhood that's not as good or has some problems with it is going to trade at a higher cap rate. And then on top of that, the market's going to impact cap rates. So what investor sentiment is at the moment will also lower a cap rate or increase a cap rate. So if the market is feeling a little skittish, the cap rate is going to go up because that means people are willing to pay less for the same income stream. So I know that these are probably topics you guys talk about already, but it's just important to understand.
Yeah, no, it's good to review and just always recognize the inverse. A low cap rate equals a higher value, high cap rate, more cash flow, but less retail value, kind of thing. So that's always good. Good starting point. And I appreciate you emphasizing the NOI does not include debt service. Because I think that sometimes people that are newer may not recognize that debt service is not included in that. So,
Yeah, for sure. And the reason for that is because let's say you're a cash buyer, Darren, and I'm going to buy a property with a loan. If you go in and look at a property, you're going to look, we want to have an apples to apples comparison. So when you remove the debt service, which is a big factor, that allows any buyer to look at a property with a slightly different or with a relatively apples to apples comparison. Now, that being said, it's always important to dive into the numbers and verify what it is that a broker is putting in front of you. And usually it's probably going to be, your analysis is probably going to be a little bit different than what you're seeing in an offering memorandum or, a deal presentation. Okay, so let's dive into a specific example. So let's say I own a 10-unit property, just a 10-unit property, and it's a multifamily property. And let's say I go and I buy it and I start to improve the property, and I increase the rents by $10 a month. Okay, so just $10 a month, right? So $10 a month times 10 units equals how much?
100.
$100. So that's $100 a month in extra income. So if there was no other changes, that would increase the NOI by $100 dollars per month. And if you multiply that by 12 months in the year, that's $1,200, right? So
Yep.
the only thing we did is increase the rents by $10 a month, and we have net operating income of $1,200. So if we apply a 6% cap rate, and of course, this is where you have to be really honest with yourself, but let's just say we're playing this out and we're saying that it's going to trade at a 6% cap rate. So 1,200, you can do this on your calculators with me if you want to practice, divided by 0.06 equals 0.06 equals $20,000. So we just increased the price that the property will trade at by $20,000 just by increasing the rents by $10. So $10 is not a huge increase on rent, right? So let's say we actually renovate the units and we're able to execute a renovation plan and we're able to increase the price of the units, the rent of the units by $150. So in this case, we're going to take $150, multiply it by 10 units, that equals $1,500, multiply it by 12 months a year, that's $18,000. And then we're going to apply a 0.6% cap rate. And that's now $300,000. Okay, so let's say that we bought this property for $730,000. This is a real example. We did buy a property for $130,000 and sorry, $730,000, and we used $230,000 of equity in order to purchase it. So that $230,000 down payment included money for renovations as well as the down payment. So if we can execute those renovations in a short period of time, maybe 1 to 2 years, then we can theoretically, as long as the market holds strong, increase the value of the property by $300,000, which more than doubles the equity that's in the deal. So that's pretty powerful, right?
Yeah. Yeah. So wait, back up here 1 second. So 730 was the purchase price,
Yeah.
and you said 230 was cash that you came in
Yes.
with.
Mhm.
So what was the loan balance on that?
So the
Was it
loan balance, I mean, was approximately 730 minus 230.
well, that would be 500,000, but
Then we also had money for renovation. So
right, I
yeah,
was gonna say, so if part of that 230 was for renovations.
exactly. So yeah, so we had about 75 set aside for renovation. So 425 was the loan balance.
Okay. Got it. Okay. All right. So you do the renovations,
Yeah,
you increase the rents,
Yes.
Increase the net operating income, which is the number we use to calculate the value. Cap rate, did it change at all from the beginning of the project to the disposition? Did the market
So,
cap rate change or?
so we haven't disposed of it yet,
Okay.
but I mean, I think it's an important thing to look at, right, for all investors when you're assessing risk. So if the market's going to get better, then the cap rate's going to be lower than what it would be. And if it gets higher, if the market gets worse, it's going to be higher. And also, as you improve the property, the cap rate's going to change. So if you have fully renovated units, low, few maintenance issues, then you're going to have a lower cap rate. That's going to also decrease. So with the renovations, our cap rate's going down. And also, is the market improving or not? And in our case, this particular property is in a place where the population is growing quite quickly. So the price of the cap rate has, yeah, I mean, we're just basically targeting the same cap rate, but it's important to look at if the cap rate goes up and if the cap rate goes down in your analysis. So you kind of have some idea of what the guardrails are, because that number alone can just tremendously impact your projections.
Yeah. If you don't have that kind of risk projection as to the possibilities, you might be really surprised. So,
Yeah. I think it's also helpful to be able to look at the big picture and be like, well, in the grand scheme of things, with this example, we're creating $300,000 value. So like, let's say we had to sell at a 7% cap rate in that one. So you take that $18,000, and that's from the $150 rent bump, divided by 0.07. So that increases the value of the property by $257,000. So, and then if you want to go to an 8 cap, just things really start to look not that great. So that's $18,000 divided by 0.08. That's $225,000. And that's still $225,000 is still, of course, there's cost involved in selling and whatnot. But we're looking at it from a ballpark perspective. In a downside scenario, we're still almost doubling the initial equity if at an 8 cap.
no, that makes sense. That makes
So
sense.
I find that that's helpful for me personally whenever I'm underwriting, is we do sensitivity analyses, and we did those when we were working at the banks too. So you take all the different factors and you say, well, what if rents don't go up as much? And what if and what if the cap rates compress a little bit? What if our expenses go up? And we all know that expenses are going up right now. And it's really important to look at that, because you just never know when the market's going to turn, for example. So for example, when in 2020 to 2022, the market was going up so fast, rents were going up so fast, cap rates were going down like crazy. And then all of a sudden, when we had this tremendous shift in interest rates, the tables turned really quickly. Rents started to go down actually in a lot of major cities. And expenses started to go up a ton, right? And so the thing is, you just don't know when the tides are going to turn. And so you really have to look at all these deals with clear eyes and know kind of what your downside is and what your upside is. And is that a risk? Is that a position that you're willing to be in? And how do we spread out that risk, right? So how do we make sure that we're invested in a diverse way so that if this one deal does have issues, then we're invested in other things that are maybe non-correlated, right? So self-storage is not necessarily, I mean, there are some things that correlate to multifamily, but in a lot of ways, they're not correlated.
Got it. Got it. So for the individual investor, they get into an investment like what you've described, say the multifamily, the smaller multifamily. They're in it as a minority owner or an investor, not a GP, but an LP. They're in the fund. They they basically they get the return throughout the investment, and then at the end the potential for the upside. But the math that you just kind of walked through was more of just the particulars on how improving. This is the value add strategy, how you can increase the value so that then, when you correlate that to your portion of your investment, how much that increases. I mean, and it's all linear. I mean, based on the same math of what you win in as a group, that percentage return would play out to all the investors based on whatever level they invested at, right?
Yes, correct.
Yeah.
Just as a caveat to that, the operators of the deal usually own a portion of the deal. Let's say it's 30%. That's because of their efforts for obviously running the deal, finding the deal, managing every aspect of the deal. So yes, so you'll put in money, and then that's usually there might be a 70-30 split. And so, I mean, that's just as an example. It could be a little more, it could be a little less. It could be a 50-50 split. So yes, but of course that portion is correlated. So let me share a slide about that talks about what this can look like over time. Okay.
Yeah.
So this is a calculator. It's a pretty simple calculator. I wanted to make it pretty simple so that people could play with it on their own. So what this is like how you can like look at a plan. So in this example, these are the cells you can change. So 25,000. So what this means is you're going to invest $25,000 every single year for the next, let's say 15 years. And we can play it out to 20 or 30. And you're going to put it into these types of deals, right? Maybe you're going to put the rest of your savings into your 401k or other investments that you want to pursue. And then we're assuming a 25% tax rate. Of course, that could change depending on your situation. And then we have an assumed annual rate of 15% here, which is pretty conservative because, like I said, we're usually targeting 17 to 20%. Sometimes it's higher, sometimes it's lower, but this is a pretty conservative. I believe this is a pretty conservative number. So you can change this. So even just for the person who puts $25,000 a year in, and then these in the pink, we're going to assume that this $25,000 grows by 15%. You have to pay taxes in year 5, and then this is what you're able to reinvest in year 6. And so, and then this 39,000 is going to grow at 15%. And then in year 10, we're going to sell, and then you're going to have to pay taxes, and this is what you reinvest. And then at the same time, this stream of money is you had also in year 2 invested 25,000. In year 3, you'd invest in 25,000. In year 4, you'd invest in 25,000. And that, by the way, is the minimum amount, that you could probably put into any types of these deals. Usually the minimums are higher than that, but sometimes you can find deals. We can sometimes offer deals with a $25,000 minimum. So then we go down to the pink. So at the end of 10 years, if you invested $25,000 and it grew at this assumed rate, then you would have $431,000. That would be the sort of net value, the total value of your investments from these different income streams. And then in 15 years, it would be $842,000. So that's if you put, let's see if I have to download this too. So if I can change this, I have to download this to actually edit it. But if it was $50,000, then that amount's going to increase by quite a lot because there's exponential growth that's happening there. Okay, so let's say we want to tweak this a little bit and we want to put $50,000 in a year instead of $25,000 a year. Then in year 10, we've got $863,000. And in year 15, we've got $1.685 million. And again, we can also tweak this a little bit. If you want to say like, well, it's going to grow at 12%. If you want to be more conservative, you can see how that would impact it. Let's just say we leave it at 15%. Then over here, I have a little chart that shows you where you're going to be at the end of 20 years. So if you do $50,000 a year for 20 years, you'll be at $3.2 million just from these types of investments. So, and of course, if you want to increase that to $100,000, which might sound like a lot of money for some people, but for some people, it's totally doable. And you would just be able to increase that total value of those investments to 6.5 million. So the power of this also goes into, the quote about compounding interest and how Albert Einstein had said that. Albert Einstein said, "He who understands it earns it, he who doesn't pays it." And so this is where it's really powerful when you keep doing this over a long period of time.
Yeah. No, it's impressive when you see the the growth curve there and how the amounts increase so much. And like you said, you're projecting what is it, 5 years? Every 5 years is the sale reinvestment type thing. But it's impressive when you see that number. I mean, in the first couple of years, it doesn't seem like much, but it's again over time. I've always felt like that's the secret or the real the beauty or the secret of real estate is, and I've heard people say it is invest and wait, don't wait to invest, kind of thing. Let it take its time, and over time, there's a natural appreciation based on just the values, and and part of that too is if you have traditional financing where there's a principal pay down, you get that spread on the that plus the appreciation. Not always so significant on the payment of the principal, but more of the appreciation. I mean, it is something. So that's
Yeah,
good.
for
That's
sure.
good.
And then of course, I mean, where I think that I didn't share this part, but if I think where the exponential interest gets like really exciting is around years 28 to 29. So this is, investing $100,000 a year, and after 30 years, that becomes $16 million, which is really a tremendous amount. And of course, that's assuming that we're hitting that 15%, which again is still conservative for most of these deals. And I think that just if you can get excited about this bigger picture, then it can help you make the steps that you need to make every single year to be able to invest $100,000 a year or $50,000 a year, rather than, um, just if you don't have that big picture, then it can be easy to kind of take those steps, I think.
Right, right. No, and I think the thing I've always appreciated about real estate as opposed to stocks and that is just again there's a proven path of steady. I mean, over time, the values have always gone up. I shouldn't say always, but most often, if you're doing your homework and you're buying in an area of demand, where there's demand and growth and it's a pretty good chance. I mean, I've got into some things that it just over time it worked, but in the beginning it was like, oh, what have I done, kind of
Yes,
thing. And
for sure.
because I've bought in the market when prices are depressed, and I've bought in the prices at the top, and all of them they've worked, but it's because I've had the patience and the ability to stay in them as opposed to have to get out, kind of
Yep.
thing.
Mhm.
And I think one of the lessons I recognize now more than what I would have liked to recognize earlier on was that one of the beauties of the American economy is the up and the down, because it creates the opportunities. And whereas most of us, if you're on a tight budget, you want to just know that your expenses are going to be what they are, kind of thing. They're not going to up and down and up and down, but that's just not the way it is. It's the reality is there's some yin and yang all the time. And you know, if you have some dry powder and some money on the side when the prices are depressed, that's when you can really make some money. So
For sure. Yeah. I
it's
think
good.
also I'm of the mindset also that we are forcing appreciation rather than waiting for the market to appreciate. Of course, it's still important to help. We still need to make sure the stars are aligned to a certain extent. So we still obviously want to sell and at a point where there's been natural market appreciation. However, with what we do at Lux and where we're really focused is on that, what we call forced appreciation, right? Where we are actually improving the value of the property by renovating it, making operations run more smoothly, um, economizing on expenses when possible, making sure it's running efficiently, and also increasing that net operating income, increasing the revenue side as well. So I think with investments, it's important to understand that there's things that are going to be outside of your control, like market forces are generally outside of your control. Of course, you're selecting the market that you're going into, so you want to feel comfortable with that market. But there are going to be market forces that are impacting your property. Then there's what you can control as the operator. So you can control how you run the business of that building. Are you offering concessions? If it's if there's a lot of, if it's a not a tight rental market and if rents are going down, are you offering concessions? What's the right amount of concessions to be offering? What is the goal? Do we want economic occupancy or physical occupancy? And then what are we doing on our expense side? Can we cut expenses, or is it better to invest in improving the operations? And these are all decisions. There's like a multitude of decisions that need to be made all the time. And so we want to be able to force that appreciation rather than just rely on market appreciation. Of course, it's always great to have market appreciation because that just magnifies the impacts of your forced appreciation.
Yeah, no, and I appreciate you emphasizing the force appreciation because that, again, when I first started, I didn't quite understand that, but that's really the beauty of these larger deals and doing your underwriting and understanding the market and the ability to, reposition a property to where it's performing significantly better than what it was for the prior owner, the seller, and be able to provide those returns to your investors. Um, I mean, that's really that's in my mind that's the probably the one thing that takes more risk out of the situation is because you have a real path and there's evidence that shows that if you do this, you'll get that.
Yeah.
And
I'd
so
also like
that's
to just add on to that because I think you're right. Like the forced appreciation is a way to mitigate risk,
right.
mitigate the market risk. So if anybody's, been invested in multifamily over the last few years, and you know that if your deals have been exposed to increasing interest rates or decreasing rents, which has happened in some markets, um, it's been challenging on some properties. So one way that we have also found to mitigate market risk is by investing in affordable properties. So what that means, for example, is um, we are investing in properties where we can get property tax abatements for keeping, let's say, 50% of the units at an affordable level. So the government, city governments will actually give you an incentive to preserve affordability at existing properties. And why is that? Well, building affordable housing is almost brand new affordable housing is almost as expensive as building brand new market rate housing. And so what's more efficient, to preserve affordability at older assets or to build brand new affordable housing? Now we need a multi-pronged approach, but some cities are doing this. They have these preservation programs, and you've got to, they're complicated. Not every operator wants to dig into the details of how can we do this? How can we build those relationships? How can we be someone that the city wants to give these property tax abatements to, for example? But what that does for our investors is when we find operators who are willing to do that, then that takes some of the market risk off the table because we've got a property tax abatement, which is helping the NOI of our property. It's decreasing expenses, and we have almost like a guaranteed pool of renters that are going to be at an affordable level. And in some cases, we still have potential upside, right? So we have 50% of the units that can go to market. This is just an example of a deal. And so if we have 50% of the units that can go to market, if and when rents do increase, then those 50% can take advantage of that. And so we have possible upside there as well as downside protection from the 50% affordable units. So in any case, we're always looking for ways to mitigate risk for our investors and have control on things where we don't always have control. We don't have control over market risk, but if we do these affordable deals, then we do have a way to mitigate the risk.
No, well said. Excuse me. Hey, Suja, if we could, I'd like to shift gears here for a second.
Yeah.
By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. That's not an option. We look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be the market, investors, interest rates, the Fed, um, political, local, whatever it is that you see and identify to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Sujata Shyam, what is the biggest risk?
So with what I do, Darren, where we invest as a fund of funds, where we're investing as a group and placing that capital as one investor into a property or an opportunity of sorts. In my view, the biggest risk by far that's out of our control is the operator. So the operator, we have trust in the operator. We're basically betting on the jockey in a sense. There's lots of things we can control for. Do we like the deal? Do we like the market? Do we like the property? Do we like the business strategy? But we're trusting the jockey to execute the business plan, or the operator, as we call it. So the biggest risk for me really is that the operator mostly it's that they start acting in their own self-interest rather than in the interest of all the investors. And we try to put lots of controls on that, but ultimately they can still cause a lot of trouble if they decide to, if they get squeezed, or if they decide for some reason to get too aggressive. That is by far the biggest risk that we have to look out for. And that's why trust in an operator and trust in the people that you're operating with, and that they have not only the integrity that's needed, but also the capacity to manage the types of deals that they're doing, as well as the decision-making ability to know, have I gone too far? Is this like a little too far outside of my capacity? Do I need to scale it back so that I don't put investors' capital at risk? That's really the biggest risk, is the people.
Yeah, well said. Suja, where can the listeners go if they'd like to learn more or connect with you?
So I also have a podcast, Darren. It's called Passive Income Unlocked. So listeners, feel free to check that out if that's something you want to tune into. And if you'd like to reach out to me personally, you can contact me on my website. That's www.luxe-cap.com, lux-cap.com. And you can also email me, and that's Sujata, Sujata, at luxe-cap.com. Feel free to send me a message. I'm always happy to chat with anybody about their specific situation, and share perspectives on what's interesting, what's top of mind in the real estate world.
Awesome. Well, Sujata Shyam, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you so much, Darren. Really great to be here, and have a great day, listeners.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.